Are you tired of seeing your savings earn next to nothing in a traditional bank account? I mean, with interest rates at rock bottom, it feels like your money is just sitting there, losing value to inflation day by day. It's frustrating, right? You work hard for your money, and you want it to work hard for you. What if I told you there might be a new way to get some serious yield on your cash? Something that leaves those old-school savings accounts in the dust. Today, we're diving deep into the world of stablecoins. Could they be the high-yield savings account of the future? Let's find out. First things first, what exactly is a stablecoin in the often wild world of cryptocurrency, where prices can swing dramatically in a single day? Stablecoins are designed to be an island of calm. Unlike Bitcoin or Ethereum, a stablecoin's value is pegged or tied to a stable asset, most commonly a fiat currency like the US dollar. So, one stablecoin like USDC or Tether aims to always be worth $1. They achieve this stability in a few different ways. Some are backed by actual cash and short-term government debt held in reserves. For every digital coin issued, there's a real dollar sitting in a bank account somewhere. Others use algorithms or even other crypto assets as collateral to maintain their peg. The key takeaway is their goal: to offer the benefits of crypto-like fast, global transactions without the crazy price volatility. So, you've got these digital dollars. How do you actually earn high yields with them? This is where DeFi, or decentralized finance, comes into play. DeFi is like a whole new financial system being built on the blockchain without the traditional banks and middlemen. Within this system, there are lending and borrowing platforms. You can deposit your stablecoins into these platforms and lend them out to others. In return for providing this liquidity, you earn interest. And here's the exciting part. The interest rates, or annual percentage yields APYs, can often be significantly higher than anything you'd find at a traditional bank. We're talking rates that can sometimes be in the double digits. Why are these rates so high? It's all about supply and demand. In the crypto world, there's a huge demand to borrow stablecoins. Traders might borrow them to leverage their positions, meaning they want to make bigger bets than their capital would normally allow. Others might use them to participate in different DeFi opportunities without having to sell their other crypto assets. This high demand to borrow pushes up the interest rates for lenders. That's you. Essentially, you're acting like the bank, and you're getting rewarded for it. Unlike a traditional bank that takes a huge cut of the interest earned, these DeFi platforms are often more efficient, passing more of the profits directly to the users who provide the funds. Now, this all sounds amazing, almost too good to be true. And whenever you hear that, it's crucial to ask, what are the risks? Because, yes, there are definitely risks. The biggest one is smart contract risk. DeFi platforms run on code or smart contracts. If there's a bug or a vulnerability in that code, a hacker could potentially exploit it and drain the funds from the platform. It's happened before, and it's a real and present danger. Think of it like a digital bank vault with a potential flaw in its design. While developers work hard to audit and secure their code, no system is ever 100% foolproof. Another major risk is what's called depegging risk. Remember how we said stablecoins are supposed to be worth $1? Well, sometimes they can lose that peg. If there's a crisis of confidence in the company or the assets backing the stablecoin, people might rush to sell it, causing its price to drop below $1. We saw a dramatic example of this with an algorithmic stablecoin called TerraUSD. Its collapse sent shockwaves through the market, while fiat-backed stablecoins like USDC are generally considered safer because they have real-world assets in reserve. The risk isn't zero. If the bank holding the reserves were to fail, or if there were legal issues, it could impact the stablecoin's value. Then there's regulatory risk. The entire crypto and DeFi space is still very new, and governments around the world are trying to figure out how to regulate it. New rules could be introduced at any time that might change how these platforms operate, what kinds of yields are possible, or even whether you can access them at all. This uncertainty is a risk factor you have to consider. Unlike your traditional savings account, which is likely insured by the government up to a certain amount, like FDIC insurance in the US, your funds in a DeFi protocol typically have no such protection. If something goes wrong, your money could be gone for good. So, how does this all stack up against a high-yield savings account from a traditional online bank? Let's do a side-by-side comparison. With a high-yield savings account, your returns are pretty modest, but your risk is extremely low. Your money is insured, the bank is heavily regulated, and the platform is simple to use. It's a safe, predictable, but low-growth option. With stablecoin lending, the potential returns are much, much higher. You have the opportunity for your money to grow significantly faster. However, the risks are also substantially higher. You're dealing with technical risk, market risk, and regulatory uncertainty, all without a safety net. It's a higher risk, higher reward proposition. So, should you ditch your bank and go all in on stablecoins? Absolutely not. That would be incredibly reckless. A smarter approach is to think about this in terms of risk allocation. Your emergency fund, the money you absolutely cannot afford to lose, probably belongs in a safe, insured, traditional savings account. It's boring, but it's secure. However, for a portion of your investment portfolio money that you've designated for higher risk, higher growth opportunities, exploring stablecoin yields could make sense. It's about understanding your own risk tolerance. How much are you willing to risk for the chance of a higher return? If you decide you want to dip your toes in, it's crucial to start small and do your homework. Don't just chase the highest APY you can find. Often, ridiculously high yields are a sign of ridiculously high risk. Research the platforms you're considering. Look for ones that have been around for a while, have a good track record, and have undergone multiple security audits. Diversify your funds across different platforms and different stablecoins to avoid putting all your eggs in one basket. Never invest more than you are truly willing to lose. It's an exciting and innovative space, but it's also the Wild West. Protect yourself accordingly. To wrap things up, stablecoins offer a fascinating and potentially lucrative alternative to traditional savings. The yields can be incredibly attractive, but they come with a set of serious risks that you just don't face with a bank. They are not a direct replacement for a savings account. Instead, they represent a new tool in an investor's toolkit, one that sits much further out on the risk spectrum. The world of finance is changing fast, and DeFi is at the forefront of that change. By understanding both the potential and the pitfalls, you can make an informed decision about whether exploring this new frontier is right for you. It's a powerful opportunity, but one that demands caution, education, and a healthy dose of respect for the risks involved. Thanks for sticking with me through that deep dive. I hope this gave you a clearer picture of the pros and cons of using stablecoins for yield. If you found this video helpful, please give it a thumbs up and consider subscribing for more content on navigating the world of modern finance. Let me know in the comments what you think. Are you using stablecoins to earn interest? Stay safe and invest wisely. See you in the next video.